Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we are going to be analyzing HUBB Inc. stock. This one came in by request down in the comment section, and since it's in the S&P 500, I'm going to post this analysis here for free on YouTube. For requests that are not in the S&P 500, I post those on Patreon, and I also post them in the full Cyclical Investors Club service. If you join over on Patreon for $5 a month, you get a big discount to the full service, and those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. So when I look at this, I'm telling you exactly what I'm thinking and the numbers that I'm looking at when I consider whether I'm going to buy a stock or not. All right, let's see. So the first thing I like to do is look at any past coverage I've had of a stock. I've never covered this one, but I do track it in my spreadsheet because it's part of the S&P 500, and it's pretty high quality too if you just look at their overall historical earnings, which is the dark green area here on the fast graph. So the next thing I like to check is the historical earnings cyclicality. So that's how much earnings decline during downturns. We really only have one significant one. That's the Great Recession, which is totally understandable. Earnings growth fell by about 20%. We had a little in 2006. There have been a few flattish years, a few modest decline years. But for the most part, this is a stable and growing business based on earnings. A couple things I will point out. Let me shrink this down to more of the current time frame, and I'll bring it back to the longer term stuff a little bit later. So the next thing I would want to look at what the historical earnings let me know is if they're not too cyclical, then we can use earnings and earnings growth to estimate what the future returns might be of the business and of the stock, and based on the amount that you're going to pay for future earnings. So I use the history to try to help me guide me toward what the future might be, taking in several other considerations. But that's the main thing. And I found about 80% of the time, if you make the proper adjustments for a few other things, the history will guide you pretty well and to the medium-term future, like 2 to 5 years into the future. So the one thing I do want to point out, well, there's a couple things. One is we have this big earnings growth year in 2018, which is a big tax cut year. It's probably not repeatable, and we actually can see that it hasn't been repeatable. The other is maybe some of this COVID stimulus money spike. This came a little later than a lot of businesses, and I don't know for sure if that's what's causing it, but I would assume that's the case, and that this is probably not repeatable either. So when we're trying to estimate the earnings growth rate, I don't remember exactly what adjustments I made for this in the most recent spreadsheet update, but I know that my earnings growth rate came out to 6.22%. And if you look at the years that are not these kind of outliers, that's pretty much what we see here, especially if we went back a little bit farther. We see kind of mid-single digit earnings. This isn't really a fair year either because that's COVID, but then we also see analysts are expecting 7% once this boom flatlines basically, or peaks or whatever. Now, these might not come true, but it does make me think that my 6 to 7% earnings growth is like a fair earnings growth rate. And maybe even if I didn't do this, but we'll just do it. Let's go back to, so before COVID, let's say before the tax cuts, let's see what they did. So if we just use fast graphs here, let's go right before the recession to right before the tax cuts. So that's a good decade. And if we look at the earnings growth rate there, it was only like 4.61%. If we get in that kind of little extra year, which was a good year before that, then we're up to that 6% range. So if we go pre-COVID, pre-tax cuts, and we just kind of look at what they're doing, including a recession, I think that 6 to 7% estimate is fair from here. However, it doesn't really include like a recession assumption. I can tell analysts are not assuming a recession is coming because there's not really any decline here. and we saw a 20% decline after the last one. So we could say that whatever next year, if there is a recession coming out of it, these long-term average growth rates are probably maybe what you could expect. So that's what I'm using is 6 to 7%. The next thing that we need is the current earnings yield, which at a PE of 20 on the fast graph, I'm not sure what mine will come out to. They have a tiny bit of debt, not really a whole ton, but I'll take that into consideration as well. Fast graphs has the earnings yield at almost 5%. We'll see what I have. I am using that $15.20 estimate for the rest of this year that Fast Graphs is using. And I'm actually almost right at the same as Fast Graphs, just slightly more conservative at 19%. And then once we take debt into account, I get an earnings yield of 4.77%. So this is the inverse of the PE ratio. Let's see what was Fast Graphs was again. So I'm almost exactly the same as Fast Graphs, slightly more conservative. So the way I like to think about this is if I bought this whole business for $100, it would earn $4.77 a year. And I basically just work out how much money I could collect if I owned the whole business and I kept all the earnings for myself. Like they weren't reinvested in buying back stock or anything like that. I checked these guys' stock buybacks. They didn't have very many, so it's not a main factor here. So the first year, if you get the 6.5% growth or 6.22%, you have about $5.07. And then that $5.07 grows at that rate for 10 years. And after 10 years, you have $167.50, including your original $100. So if you put that in a CAGR calculator, which is what my spreadsheet does, you have a 10-year 5.29% business owners CAGR. That's, I would say, a little more expensive than the average S&P 500 stock right now. Just a little bit. It's pretty much in line with the rest of the market, though. So, and if this gets below 5%, then usually stocks I consider selling based just on the valuation. So it is expensive. I would say it's expensive even if we don't have a recession is kind of how I would describe it. But it's not so crazy expensive. It's just a no-brainer sell. If you think about it, this is about what cash earns right now. So if you want to compare this to like short-term treasuries, the comparison is if we have more inflation, these guys have the ability to pass that inflation on. So we can say their 5.3% expected 10-year yield plus inflation, you get a inflation kind of protection. If you do the short-term cash, you don't have inflation protection. You would, I think that, I don't know what the 10-year treasury is at. It's more like at 4.3 or 4 or something now, I think. So I usually use short-term because I don't buy like long-term bonds. But so you do have some reinvestment issues if interest rates slowly come down, if you use short-term like treasuries or like money markets or something. But the big issue there is really inflation. You don't have the same sort of inflation protection if you buy like a bond at the same rate that if you buy stock. So, but what you do have is recession protection. So, or just lack of growth over whatever time period you go. Usually I'm not out more than I'm less than 2 years when it comes to like cash and things like that. So for me, I think, okay, over the next couple of years, is the recession risk high or is it low? I think it's relatively high. So I don't see the inflation risk. Well, first of all, short-term stuff doesn't have inflation risk, but I don't see the lowering of yield risk, which is a couple percent maybe, or the reinvestment risk, however you want to think about it, to be very high. And so for me, that's about the same. The risk is bigger that the stock price will fall of a stock over the next couple years. So for me, this is riskier than cash. But if inflation or stagflation, if we just kind of muddle along and we have kind of inflation the whole time, but we never have like a big recession or the stocks never sell off too much, then holding a stock like this long term would be better. So this is technically a hold, but not a emphatic, not an emphatic hold. Definitely not a buy, right? So the price it would become a buy is when this gets up to about 8%, when the 10-year CAGR gets to 8%. At $175, it would become a buy. The current price is $300. So it needs to fall about 42% to hit a buy price. And at that point, I think the risk reward would be really good if we don't think a recession's coming. Like even a slowdown, that price would be fine. But if we get a real recession, then that's when we need to get more conservative. So my deep recession buy price is $113. That's 62% lower than the price is now. And the way I come up with that is I went back to 2008. So this is a pretty, I would say, conservative estimate of how much the stock could decline. And what I use is called a recession PE that I just make up myself. It is the low price during the last recession. This case is 2008. And you take the low price and the high earnings, the highest peak earnings, and you create a PE out of that. That gives you a kind of very pessimistic PE ratio that you can use even when earnings are falling during a recession. So it's right now the peak PE is expected to be 15.2, so $15.20 a share. And what I want to know is, based on that, how low would the price have to be to get to this recession PE? Now the 2008 recession PE is 5.63. I don't expect to get like an exact bottom, but I want to get kind of close to that. So I give it like a 40% cushion above that, which is a 7.88 recession PE. Okay. And that's what's displayed here. And what I want is for this PE, even if current earnings fall, let's say we end this year and they make the $15.20 a share. And next year there's a recession, earnings fall to $9. Well, I'm not going to be using those $9 a share because that can make things at a certain point look worse than they really are. I'm going to base it on that peak PE, or that peak earnings per share. And that will stay steady once the year ends and if earnings come in at that rate. So no matter how horrible like a recession year gets, you're not basing it on the current earnings, which is what most people are going to do. So that can allow you to get a lower price when other people are not willing to step in and buy, because when they run the numbers, then the numbers are going to look really horrible. And when you use a recession PE, you're assuming that the recession will end and the earnings will eventually recover. But you also don't want to pay too much. So it's just a way to kind of help you get a cheaper price. It does help prevent you from buying too early during peak times, which is kind of where we're at now. And when you do that, when you put all that together, you're looking at a $113 buy price. So that's kind of where I'm at here. I don't think there's too much else. It looks like a high quality business. I would definitely buy it. If we get past recession risk, then that 175 looks good. I still think there's recession risk given where interest rates are. The economy is probably going to slow down. Who knows the exact timing, but I don't want to buy too soon. I would rather buy after the recession and kind of see what's available. Or if we don't have one, if we just muddle for 3 years, and that recession risk comes down, then I could go back to my normal buy price, which was the let me look at it again so I don't say it wrong, $175 a share. All right. If you found this useful, click the subscribe button, and if you have a request, put it down in the comments section, and I will get it on the whiteboard behind me, and I will eventually make a video. Thanks a lot. Later.